Hey guys, what's up? Welcome. It is the Impeccable Investor here. In today's video, we're going over why Michael Burry is predicting the index fund bubble. Now again, guys, we're going to go over what exactly he's saying here, why it makes sense, and if it's actually something you should be worried about. All right, guys, let's get into the first clip here and we'll discuss more about this.
B's, 0. Double B's, 0. Triple B's, 0. And then that happens.
What is that?
That's America's housing market.
In this clip of The Big Short, it shows how Michael Burry predicted the 2008 housing market crash. This is a great movie that shows exactly how these investors knew exactly what was going to happen. But Michael Burry knew exactly what was happening in the housing market way before it actually happened. He thought it would even happen as early as 2007, but it didn't actually happen until 2008. That's how far ahead his predictions were. Well, does that actually hold any weight with this new index fund bubble hypothesis? Well, let's actually look into that here in just a quick sec. As stated by CNBC, Michael Burry of The Big Short, which is the clip I just showed you, it says that he's found another market bubble. All right, guys, he's saying that passive investments are inflating the stocks and bond prices in a similar way to 2008 with the mortgages. All right, guys, he's also saying, like most bubbles, the longer it goes up, the worse the crash will be. So is that something that should scare you? Well, let's get into that real quick and explain what's going on. All right, to start off, you need to understand what an index fund is. And index fund examples include the S&P 500, the Dow Jones Industrial Average, NASDAQ, the Russell 2000, and so much more. These are index funds, which means they are a fund that holds a bunch of different stocks. For instance, the S&P 500 tracks the performance of the top. It says 500 here, but if I thought it was around 502. But the point is, these funds track the top performing so many number of stocks. For instance, the Dow Jones tracks the top 30 largest U.S. firms. So if you can see here, each thing is tracking all these different stocks. So again, you're not investing when he's saying an index fund bubble. He's saying that the fund is related to all these indexes, not necessarily to individual stocks. But now that you know what an index is, it's just something that tracks a bunch of stocks. You'll be able to understand when we go into why this is an index fund bubble that he's discussing. All right, to understand this more, you need to understand the difference between active and passive equity flows. So basically, you have fund managers, the hedge funds, the money managers, the people who do a lot of big name stuff like Wall Street, okay? There's two different ways that they invest your funds. Either they actively invest in individual stocks or they invest in indexes. Indexes have a return of 9.8% over the past 90 years that they've been on the stock market. So that's why a lot of people go with passive funds, because it's an easy way to do it. You put your money in it and long term it goes up, right? You don't have to worry that you're picking one bad stock. Okay, well, if you can see here, the white portion of this picture is from all the passive equity funds. So people who are putting their money in from passive forms like an index fund. The red is the money that's leaving from individual stocks. So what is this showing? It's showing that more money is going into index funds than into individual stocks. Well, why is this a problem? Well, I'm actually about to show you why. As you can see, the P to E ratio is what is being affected here when people invest solely in the index fund. So what's happening is when people invest in a single stock, the stock price rises because it's a good buy, because more people are investing in it. However, when people put their money in an index fund, what that fund does, once it gets that money from the investor, it goes out and buys more shares, more holdings of the companies that it holds. So these stock prices are being raised because they're being bought from the index fund. That means that the stock price may not actually be increasing because it's a good buy, because investors want it, but because the index fund is receiving more money and needs to allocate that money to those stocks. I know this may be going over your head, so let me simplify it a bit. The P to E ratio shows if a stock is overvalued or undervalued based on the stock price and the earnings. So the price of these companies, especially the tech companies, are starting to increase massively. And it's not because of their earnings, not because the company is good, but because the index funds are investing in them because they have more people investing in index funds. So what this is happening is we are seeing indexes raise the price of stocks artificially because we don't actually know what's going on here. The stock price isn't rising because it's natural. It's rising because index funds are making it happen. So let's talk about the implications of this bubble right here and how it actually affects you. Again, if you're liking this video, please leave a thumbs up and subscribe because I have so much more content coming down. The next video will actually be over what Michael Burry's stock portfolio looks like, even though he's predicting this bubble. All right, guys, so what are the implications of a stock market crash? Well, let's get a quick look at the flash crash of 2010.
Now, three even start trading out now. Three in the video now. You're going to get a low print of 11.03 even. Guys, 2 off over.
Sorry if that was too loud or exciting, but when the stock market crashes, everyone gets hyped up because people are losing their retirement. They're losing investment accounts they have. They're losing so much money, and that's something that we want to prevent you from. So let's discuss. Does this actually hold weighting? Are you actually going to be affected by this index fund crash? Well, as we discuss here, I'm going to discuss in a second that it actually doesn't really matter because it's just how the stock market works. So let's get into that right now. All right, guys, what I think is that the index funds are a way to make money in the stock market, right? They're a way to diversify your portfolio holdings in an easy, simple way. These stocks are always going to be overpriced or underpriced at certain times in the market just based on bull runs and bear runs. Well, at the moment, we've been on a 10-year bullish run, meaning that these stocks have been increasing in price for the past 10 years since 2008. Over time, you have to see a progression of bull markets and bear markets and bull markets and bear markets. And again, it's just natural for the stock market to see that decline. Will we see a bear market in 2020? Well, no one knows. Again, guys, you can watch the 200-day moving average to get you a precursor to understand if it's about to happen. But again, you never know. So basically what this guy is saying is index funds are leading the way for a bubble. But what I am saying is it's just a natural progression of movement. You don't have to take my opinion. I'm not obviously a professional. I haven't predicted the 2008 crash. But to be honest, I wasn't even old enough to know what the 2008 crash was really happening. But what we can learn from this is that we need to be safe in understanding the fundamentals of a company. We need to make sure not to invest in companies that have high PE ratios. And if we're in index funds, we need to make sure that we're monitoring the price at which it is. If it starts to drop massively and stocks are seeing that nice pull down, then we may want to look for other places to put our money, safer holdings that won't be affected by this index fund purchase. Stocks like that are the dividend kings, investing in individual stocks that have products that people will need to buy regardless of if it's a recession or not. For instance, you're looking at like Walmart, Procter & Gamble, all those companies, they produce goods, they sell goods that everyone needs to buy regardless of what the economy is doing. All right, guys, if you haven't already, please hit that like button and that subscribe button and turn on those alerts. Our next video is going to be over what does Michael Burry's portfolio actually look like.